All right, good morning, everyone. We'll make a start now. So welcome to our webinar on Jobkeeper 2 and what you need to know. For those who haven't met me before, I'm Randal King. I'm one of the senior associates here at Marsh Tincknell. I also have in the room with me Adrian Tan, who's a senior accountant here, who's just going to help me with the questions at the end. Today we'll be discussing the extension to Jobkeeper. And the new rules for determining whether you are eligible or not. Just as far as the questions are concerned, you should have a Q&A box down the bottom of your screen. If you just want to put your questions in there as we go, and I'll get to answering them at the end of the presentation. There'll be plenty of time for answering questions at the end. So what we're going to look at covering today, this is just a rough outline of what we're going to go through. So yeah, sort of just around the eligibility, the actual decline in turnover rules, which are a little bit different. We're going to look at employee eligibility, have a look at the payment rates, that's certainly a big change. Also the business participant rules, it's pretty much the same as it was before, but there's a bit of a change there. And then the alternative test, and then we'll get around to some questions at the end. So just a bit of background. I guess practically this extension came about because of what happened in Victoria and how they had to lock down all the businesses in Victoria. But it does apply obviously to all businesses in Australia. So it was originally announced back on the 7th of August that they needed to change the legislation, and that had to be voted on in Parliament. And we didn't actually get any rules enacted by the Treasurer until the 15th of September. So the detail around hasn't really been around for very long, and we're really just sort of starting to get our heads around it. So the extension of the original subsidy will run out till the 28th of March 2021. So it starts from the 28th of September, so just a couple of days ago. And out to the 28th of March. There's a two-tier payment rate, which again is different from the original Jobkeeper. There's a reduction from the original rate now, and there's also another reduction from January 2021. However, it's generally a similar structure to the Jobkeeper one. So first step, you just need to determine eligibility of your business. Again, it's quite similar to Jobkeeper 1. You need to have been carrying on a business in Australia on the 1st of March 2020. That's the most important thing. If you hadn't been carrying on a business at the 1st of March, then you don't qualify. There's no way that you can qualify. You need to have met the original decline in turnover test, which was a projected turnover test. So the decline that we're going to be talking about right through this presentation is a 30% decline. There are different rates for different sizes of businesses, basically two rates. So if you're a business that has turnover of over $1 billion, is a different rate. But I'm not going to talk about the larger businesses today because I don't think anyone here will be in that category. There's also a lower category for charities, but again, we're not going to focus on that. So you need to have met the original decline in turnover test, but there's an additional actual decline in turnover test, which is based on the quarter ended 30th of September 2020. Compared with the quarter ended September 2019. So basically the quarter that's just ended, you need to compare that with what happened 12 months ago, based on your actual numbers to see whether you're eligible. You will then need to retest that again based on the quarter ended 31st of December, again going back 12 months to determine whether you're eligible for the last payment period. While there is a requirement to meet both tests, the tax office have come out and said if you meet the actual decline in turnover test that we're going to be talking about. Because of the way they've structured it, you're automatically going to meet the first test anyway. So even if you haven't been registered for Jobkeeper in the last 6 months, you can still potentially enter the Jobkeeper system based on actual turnover. So this is just a bit of a table, I guess, that this makes it a bit clearer. So the first column is what was happening up to the 27th of September. It was all based around projected turnover, whereas from 28th of September and then from the 4th of January, it's going to be on actual GST turnover. So what you're going to do is compare July, August, September 2020 with July, August, September 2019, or for the last payment period, it's going to be October, November, December. You're going to compare that with October, November, December 2019. Just made a note there are some alternate tests that may apply if you don't meet the basic test, but we'll come to that a little bit later on. Now, the decline in turnover test, there needs to be a 30% decline, and as I've said, we're just going to talk about the 30% figure. We're not going to talk about the larger businesses. It's actual GST turnover, not projected. So generally what that means is you'll compare what's actually included in your activity statement that you provide to the tax office. You're going to compare your September activity statement with your September 20 activity statement with your September 2019 activity statement. If you report on a monthly basis, then you are going to need to add together 3 months to get to that quarterly figure. So for instance, for the September quarter, you would need to add together your July, August and September activity statements and then compare those to the same 3 periods 12 months earlier. One important point to note is that it includes all sales that are subject to GST. So it includes capital sales. So for instance, if you've gone and sold some equipment, vehicle, whatever, to help you sort of get through the period of low income, that will be included in this comparison. So just need to keep that in mind. Also, you're going to need to get your activity statements prepared pretty quickly. You've got a lodgement deadline with your activity statement sort of into November in most cases. However, you're going to need to know well before then, because you're going to need to know by the 31st of October at the latest to be able to be eligible for the payments, because you have to meet what we call the wage condition. That means if you need to make any top-up payments to any of your employees to bring them up to the Jobkeeper amount, then that needs to be done by the 31st of October. It can't be done any later. And again, we'll talk about the alternative test later on. So another important point with the decline in turnover test, you must use the same GST reporting method in your comparison. So you must compare cash with cash, or compare accruals with accruals. You can't mix and match when you're calculating the decline in turnover. And also you can't choose what method you use. It's determined by what your method was back on the 1st of July 2019, or when you first commenced business, if you commenced business after that. Even if you've decided to change your GST method since July 2019, what you had at July 2019 is what you need to use. So just be aware of that. If you're a small unregistered business and potentially applying under the eligible business participant rules, you can choose your accounting basis. So because you're not registered, you don't actually have a GST basis, but you must be consistent. So if you're using cash for 2019, then you need to use cash for 2020. They just need to be consistent. Next thing to look at is whether your employees are eligible. As per Jobkeeper 1, the start date is 1 July 2020. That start date was originally in March 2020, but it was changed partway through the first stage of Jobkeeper. So that's now the date, 1 July 2020. Generally, you'll need to be at least 18 years old to be an eligible employee. There are some rules around 16 and 17-year-olds, but generally you'll only qualify if you're an 18-year-old at least. It can be full-time or part-time, and also a long-term casual. I'm sure everyone's sort of had a discussion over the last 6 months about what a long-term casual is. Basically, it just means that you've been working for at least 12 months and you've been working on a systematic and regular basis with that employer. Basically only applies to Australian citizens or permanent residents or New Zealand citizens that are working in Australia. There's been no extension to various other types of visas. You can't receive both JobKeeper and JobSeeker. If you've got multiple employers, the employee can nominate which one they want to receive the JobKeeper from. However, if they've got a full-time job and they're casual and both are eligible, they can't choose the casual job over the full-time job. Also, the employees can't be in receipt of these particular payments if they're looking to get JobKeeper. They can't be on parental leave and being paid by the government, and they can't be on workers' compensation. There's a couple of other ones, but they're the main two ones. And the employee actually has to agree to be nominated. So with most of your employees, that would have already happened. They would have provided you with the form that they need to. But if for some reason you've got some new employees that are eligible, they need to nominate you as their employer. So payment rates, this is different. Right through the first 6 months that we've had with JobKeeper, it was $1,500 per fortnight per employee, regardless of how many hours you've worked. There was no change. Going forward, that top rate is going to reduce gradually down to $1,200 from now, and then down to $1,000 from January per fortnight. If you worked less than 80 hours in the reference period, which we'll talk about in a sec, you get the lower rate, which is currently $750, and then going down to $650. So yeah, the reference period is a 28-day period. So we'll go into that a little bit in a sec, but once you've established which rate that you're entitled to, you don't need to retest it. So reference period, it's 28 days finishing on the last day of the last pay period that ended either before the 1st of March 2020 or the 1st of July 2020. So what you do is you look at what your normal pay period is, whether that be weekly or fortnightly or monthly even. You look at what the last pay is prior to either of those 2 dates, and then you go back 28 days. We'll look at some examples in a sec because it makes it a lot clearer. Yeah, so it's a 28-day period. I know when it was originally announced, they were talking about 20 hours a week, but now they've changed it to 80 hours over a 28-day period. What gets included in those hours? Obviously the hours that you work, but also hours where you've received paid leave, for instance, annual leave, long service leave, etc. Or if there's a public holiday that you're getting paid for, that gets included in your hours as well. For eligible business participants, the reference period is only February 2020. There's no other reference period. And you have to show that you're actively involved in the business, but we'll talk about that a bit more. So these tests around establishing the payment rates look a little confusing when you first look at them, but let's just have a look at this example. So we've got Emma, who's been a permanent part-time employee of a bus company since 2010. The company has a fortnightly pay cycle which ends on a Friday. The bus company is an eligible employer because they've had a decline in turnover of more than 30%. Using the company's payroll cycle, Emma's hours for Emma's hours for the 1 July reference period are as shown. So there was 2 pay periods during that period of 28 days. The first one finished on the 5th of June. The second one finished on the 19th of June. The next pay period would have finished, I think, on the 3rd of July. So that's outside of the reference period. So you pick the period that, in this case, that finished on the 19th of June, and you go back 28 days to the 23rd of May and determine how many hours have been worked. So in this example, she's worked 78.5 hours. And note that in week 4, she was on annual leave, got paid 19 hours annual leave. Even though she wasn't actually working, those 19 hours get included in the calculation. You can also look at the period prior to the 1st of March 2020. Again, you go through the same process, work out which is the last pay period before the 1st of March, and then go back 28 days. So in this example, again, there's 2 pay periods, but she actually worked 81 hours over those 2 pay periods. Because she's worked at least 80 hours in either of those 2 reference periods, she's entitled to the higher rate. So you're entitled to choose the best period, the period that gives you the best rate. And like I said, you don't have to test it again. Once you've tested it and determined what your rate is, that remains for the rest of this Jobkeeper period. Another example, this time someone on a monthly pay cycle. So we've got Antonio, who's a permanent employee. The company has a monthly pay cycle that ends on the 15th of each month. The company is an eligible employer that had the reduction in turnover required. So just looking at the 1st of July reference period for Antonio, he had 85 hours. However, this month, the month between the 16th of May and the 15th of June, there's actually 31 days in that month. Because the reference period has to be 28 days, you need to prorate it. So even though he worked 85 hours in that month, you need to prorate it back to 28 days, and that brings you back to 76.8 hours. So on that basis, you would be entitled to the lower rate. But let's have a look at the other reference period. So the reference period prior to the 1st of March 2020, the hours for the 31 days ended 15th of February or 165. So again, prorating that back to 28 days gives you 149 hours. Because one of those 2 calculations that we've done provides with at least 80 hours, the higher rate can apply to this employee as well. So as I've said, there's no need to retest the payment period that starts in January. There are some alternative tests that are available if the reference period that have been set out in the legislation are not representative of normal hours. Some examples of that might be someone that's a fly-in, fly-out worker that gets rostered on and rostered off for different periods. There could be some unpaid leave for something like bushfire service, so it's not representative. Or you could have an employee that started less than 28 days prior to the 1st of March or prior to the 1st of July. Again, that's not going to be representative, so there is an alternative test. Also, you can have employees where their salary is not linked to hours worked, and so the hours aren't actually recorded. So there are a few different options where the work that's been the hours that have been worked in those two periods is not representative of what the normal hours are. Now, for business participants, the eligibility rules are basically the same as they were in the first Jobkeeper round. So, sole traders and self-employed, or shareholders of companies, or beneficiaries of trusts. So, provided that, so first it was sole traders and self-employed. If they have an ABN, they'll be eligible for payment where their turnover is fallen by 30% or more. They must have had an ABN on or before the 12th of March 2020. So the business has to have had an ABN by that date. Must have either declared income in the 2019 tax return, which needed to be lodged by the 12th of March 2020, or have lodged an activity statement between the 1st of July 2018 and the 12th of March 2020, which included some GST supplies. So these are exactly the same as the original rules around business participants. You need to be actively engaged in the business. So there's generally not going to be any payroll records that record that, but you need to show that you're working in the business and actively going about the day-to-day business of the company or the business. You can't be entitled to another JobKeeper payment. The same age and residency rules apply to employees. So as I said, it applies to partnerships, companies and trusts. You can only have one nominated participant for each entity. That can be a beneficiary, director or shareholder that works in the business, but you must be a direct participant. So, for instance, with a company, if the shareholder is a trust, then you don't have a direct participant in that situation. So, yeah, same rules as before. There's been a lot of discussion and inquiries and lobbying around businesses that commenced typically after the 1st of January 2020. So they met the requirement that they were in business prior to the 1st of March 2020. But under this business participant rule, you need to have had a 2019 tax return lodged, or your first activity statement needs to have been lodged prior to the 12th of March 2020. So if you commenced in January 2020 and you report GST on a quarterly basis, your first activity statement period doesn't end until the 31st of March 2020. So in that circumstance, you can't meet the eligibility rules. And so there's been a lot of lobbying and a lot of correspondence sort of gone with the tax office. The tax office have no discretion. It's the law. They can't change the law. So there really isn't any point in chasing up the tax office or objecting to it. The tax office can't do anything about it. So again, there's a two-tier payment rate for business participants. So that the test for business participants is just a one period which you can test it. It's in February 2020. So need to have been actively engaged in the business for at least 80 hours during February. As I said, it's unlikely there's going to be any record of the hours worked. You need to be able to show that you have regular tasks involved in business development, planning the business, regulatory compliance, so that those sorts of things that an owner would be involved in. It can be difficult to prove, but you know, whatever records you've got, and provided you're not also taking on a full-time employment with another business at the same time, I don't think there's generally going to be too many issues. But just keep whatever records you can to justify that. Now, alternative tests. If you meet the standard test, then yeah, happy days, you don't need to worry about the alternative test. But there are going to be a lot of people out there that won't meet the standard test for various reasons. So there are these alternative tests that have been legislated. So they cover areas like irregular turnover. So when they're talking about irregular turnover, they're not talking about seasonal differences in turnover. They're talking about turnover that's all over the place. And it's just not representative necessarily. So there is some alternative tests around that. Probably one of the main areas where people will be looking to utilise the alternative test is for new businesses. So new businesses that have commenced after the 1st of July 2019, really, because they won't have the September 2019 comparison. So they'll need to have a look at the new business tests. Also, where there's been restructures or part disposals or acquisitions, then you can have a look at an alternative test. Another main one that people will be looking at is the substantial increase in turnover tests. So we'll look at that in a bit more detail and look at an example. Where there's been drought or natural disaster, which has affected you in your comparison year, that you could use an alternate test. Also, where you've got a sole trader or a really small partnership where one or more of the principals have been on leave or have been sick or injured, there's an alternative test available for that. Just one thing too that's a little bit different to what the first Jobkeeper, you must indicate to the tax office that you're using alternative tests. So if you're not comparing your BAS in September 20 with your BAS in September 2019, you need to let the tax office know when you're registered that's what you're doing. So the ones that I'm going to look at in a bit more detail are the new business test and the increasing turnover test. So the new business test, so where you've commenced after the quarter ended September 2019, so after 1 July 2019, but before obviously the 1st of March 2020, because otherwise you're not eligible anyway. You need to compare your actual turnover for the quarter ended September 20, so the 3 month ended September 20, with the average monthly turnover since commencement. So you need to look at all complete months, and then you multiply that average monthly turnover by 3 so that you've got a quarterly comparison. And we'll go through an example of that just to show you that. Just as a basis of it, I guess, if you start in October 2019, you're going to be outside that original that September 19 quarter. What you will do is you'll look at your complete months, so you don't look at October because that's the month you started. You'll look at November, December, January, and February. Because there's 4 months, you'll need to divide that by 4 to get your average monthly turnover, and then times it by 3 to get a quarterly turnover figure. Or alternatively, you can look at the actual turnover for the quarter ended September 20 and compare that to the 3 months prior to the 1st of March 2020. So in that example, it's always going to be December, January, February. December 19, January, February 20. They're the 3 months that you will look at. So that'll be your quarter that you'll compare with the actual turnover for the July, August, September 2020. If another test is if you actually commenced in February 2020, then clearly you're not going to have a quarter of information to look at, or you're not even going to have a whole month of information to look at. What you will do then is look at your total turnover for February, work out what your daily average turnover is, so just dividing by the number of days that you actually traded, multiplying it by 29 to bring it out for what it would have been for the whole month of February, and then multiply it by 3 to determine what a quarterly figure would be, and then compare it with the September 2020 quarter. So they're your options with new businesses. So just a bit of an example. We've got a business that commenced in November 2019. So we'll look at December, January and February turnover. So in this case, it's 900,000. If that business commenced in December 2019, we can only look at January and February's turnover. And because it's only 2 months, we'll divide that total amount by 2 to get the average monthly of 310, and then multiply it by 3 to get a comparative quarterly figure of 930,000. So if you then compare that to determine whether you've met the 30% decline, if for instance the September 2020 turnover is 500,000, so the quarter ended September 2020, then in the first example there would be a decline of 44.4%, and so you would have passed the test. So just comparing the 500,000 with the 900,000, that's a reduction of 44.4%. Or if you're comparing 500,000 to 930,000, in the second example, that's a reduction of 46.2%. So in both cases, that's more than 30%. So you would pass the new business test. So that would make you eligible for the Jobkeeper payment. So the other alternative test that I wanted to look at in a bit more detail is the increase in turnover test. So you can apply this test if the turnover has increased by at least 50% in the 12 months prior to the test period, which is either the September quarter or the December quarter, depending on which period you're looking at, or the 1st of March, the period ended the 1st of March 2020. Or you can look at whether there's been a 25% increase in the 6 months prior to any of those periods, or you can look whether there's been a 12.5% increase in the 3 months prior to any of those periods. It's really a lot easier to work this test out if you just look at it in a table form. So if you're trying to apply the alternative test, I recommend that you have a look at this table and work out where you need to be. So for instance, if we're looking at for the September 2020 quarter, so for the first Jobkeeper round in this Jobkeeper 2, what you will do is you'll look at what your turnover was in June 2019 and compare that with what your turnover was in June 2020. If that turnover has increased by at least 50%, then that satisfies the increase in turnover test, and then you go to the next step. So if you're looking at the 6 months 25% increase, you will look at your turnover in December 2019 and compare it with the turnover in June 2020 to see whether you've got that required increase, and so forth. So they're the options for September or December. For either the September or December periods that you're looking at, you can also, as an alternative, look at the period ending prior to the 1st of March 2020. So that's going to be, if you're looking at 12 months, you're going to be looking at February 2019 and comparing that with February 2020 and so on across there. So yeah, so this establishes whether you've met the required increase in turnover. Once you've established that, then you need to determine whether you've then met the 30% decline in turnover. So this becomes your comparison. This gets you into the test in the first place, and then you have a look at your comparison. So if you use the month prior to the quarter ended September 2020, so that would be the month of June 2020, because that's the month that ends just before the September quarter. To test the increase in turnover, you need to then compare the actual the quarter ended 30th of June 2020 with the quarter ended 30th of September 2020 to determine the 30% decline. But we'll just have a look at an example in a minute, which just makes it a bit clearer. If alternatively you use the period that ended just before the 1st of March 2020, then you compare the actual turnover for December, January and February with the actual turnover for July, August, September to determine whether you've met that 30% decline. So let's just have a look at an example. So we've got Blue Co. They're on a strong growth trajectory before the pandemic. In February 2019, their turnover was 50,000. And then 12 months later, in February 2020, their turnover was 80,000. So over the 12 months between February 19 and February 20, their turnover has grown by 60%. So that satisfies the substantial growth turnover test because it's exceeded 50% over that 12-month period. Now, Blue's turnover for the GST turnover for the quarter ended 30th September was 150,000. The comparison period that we look at is the months of December, January and February, so the 3 months prior to the 1st of March. In that period, the turnover was 225,000. So they've gone from 225,000 in the comparison period to 150,000 in the September period. So that's a decline in turnover of 33.3%. And because that's more than 30%, or at least 30%, they've passed that alternative test. So that then makes you eligible to claim the Jobkeeper. As before, there are some integrity rules around the Jobkeeper system. They really haven't changed at all. They're just around contrived arrangements and schemes that you've probably seen in the press a fair bit over the last 6 months. Clearly, you have to be on the payroll at the 1st of July, so you can't be backdating wage payments or backdating when the employee was actually on the payroll. If you were to go through something like that, then there's a fair chance the tax office will want to have those amounts that you've received repaid. Just quickly, we'll go through what the registration process is. So first things you need to do, just to summarise, you need to check whether your employer is eligible, so that the 30% reduction in turnover test, but also whether your employees meet the eligibility requirements. Need to calculate the required payment rate for each of your employees and business participants. So that's the 80-hour test that we were talking about. For the October fortnight, you need to have made all payments by the 31st of October. Now, it hasn't actually been announced by the tax office, but it's expected that for the third Jobkeeper period, so from January 2021, it's likely that there will also be another extension because, again, you're going to have to complete your December BAS before you actually know whether you're eligible or not. So it's not set in stone, but that's probably going to happen for the January to March fortnights as well. You need to notify the tax office what pay rate that your employees are eligible for. Now that can be done via single touch payroll with your payroll system if you're doing that. If you're not using single touch payroll, then it can be notified online. But just be aware, once you've actually notified the tax office, you need to have notified your employees within 7 days. That's just a requirement of the legislation. If you've got employees that haven't not already nominated, then you need to get a nomination notice out to them just to make sure that they're prepared to be nominated for Jobkeeper. I know the tax office have put out a bit of a guideline, I guess, just sort of setting out all the different dates and what you need to do. Basically, it just covers off on what I've said. But if you're not sure on the different times that you need to get things done by, I'll send that out to everyone. It's just called Jobkeeper extension. What you need to do as a business or non-profit. So it's just a bit of a one-page guideline brought out by the tax office, which might be of assistance to you. All right, so that's the main part of my presentation. I note that we've probably got a few questions that have come through. So what we'll do now is have a look at your questions, and I'll see whether I can answer them for you.
Good morning, everyone. It's Adrian here. I'll just run the questions by Randal, and he'll answer them one by one. So we've got the first one, which is from an anonymous attendee, asking whether the turnover test is as per the BAS figure that's lodged or from the accounting software.
Okay, so essentially it's going to be what's recorded on your activity statement, because that's what the tax office are going to check if they do check it. So if depending on what your accounting method is with your activity statement, whether it be cash or accruals, that's how you need to calculate your turnover. So you might potentially have some items in your general ledger which might actually be income but aren't actually turnover. For instance, interest, investment type income, that's not going to be included in turnover. Or if you've got a rental property, a residential rental property, that's what's called input tax, so that's not included on your activity statement. But yeah, it's going to be what you're included on your activity statement each quarter is what's going to be looked at. Just keep in mind, it does include GST-free turnover. So, for instance, if you're in an industry where you're selling fruit, for instance, that's not subject to GST. It's GST-free, but the turnover will get included in this calculation. So just be aware of that.
Perfect. The next question's again from Anonymous. This one's focused around the 80-hour test, and just wondering if you choose one period, let's say the March period, can you choose an alternative period for another staff member?
Yes, that's correct. You're not locked into one reference period for all of your employees. You can look at whichever period gives you the best result. So logically, you are going to be looking at both periods, and the one that gives you 80 hours or more is the one that you're going to choose. So yes, you can look at either for all employees.
David has a question that's referencing the substantial turnover test, and that is whether that's always a 28-day comparison period.
I think that's probably the employee test, isn't it?
Oh, it's just further down. It's,
David Higgs, is that one?
Yeah. That's,
so I assume you're talking about the 28-day comparison period for. Oh, there's further questions. Okay, sorry. Just go down to that. Oh, substantial turnover test. So no, it's a monthly comparison. So you look at what the turnover is for the month. So the 28-day period only relates to the 80-hour payment rate. All the other tests are on complete months, with the exception of where your business only started in February, where you look at the actual days that you've traded in February and then work back to a monthly basis, which is obviously in February is going to be 29 days. But the 28-day comparison period only relates to the to whether you're what rate the employee is eligible for.
Perfect. The next question is from Nicola. So she's asked, she has a casual employee who's been ignoring their calls to work. Can she terminate their Jobkeeper entitlement, or are they going to continue receiving it?
Okay, that's not really a tax question. That's more of an industrial relations type question, which I'm probably not really qualified to answer. I don't think you are allowed to terminate their Jobkeeper entitlement, but you certainly do have some industrial relations type issues. I know Fair Work are providing a free helpline service for employers. I would recommend that you ring Fair Work and talk to them about your circumstances, because it's certainly an issue, and it has been an issue for a number of employers. It's not dealt with in the Jobkeeper legislation, because it's not about tax, and it's not about whether you're entitled to the Jobkeeper payment. It's about what you do with an employee that refuses to work. So that's a Fair Work issue.
Thank you. I do have a question from Richard, who's put it through the chat. He's asking around his sole trader business, which started in May 2019. It doesn't have any employees and isn't registered for GST. He hasn't been required to do a BAS, so he's asking, how does he report his actual income drop from September 2019 quarter compared to the current quarter just gone for the Jobkeeper extension?
Okay, yes, you're right, you don't need to register for GST. So as long as you've lodged your 2019 income tax return by the 12th of March, I think it was, 12th of March 2020, then you will be eligible. Notwithstanding you haven't lodged a BAS, so clearly the tax office can't check your BAS, you need to look at what your turnover was for September 2020 compared to the quarter ended September 2019. So you need to compare those two quarters. You can choose whether you do that on a cash basis or an accruals basis. So you can do it on the basis of what cash you actually received during those two quarters, or you can do it on the basis of how much you've invoiced in those two quarters. You can't mix and match, but you can choose whether you use accruals or cash. So yes, notwithstanding you haven't lodged a BAS, you still can calculate it, but it's just based on your actual records as to what your sales were in each of those periods.
Thank you. Glenn's asked a question around casual employees. They've turned 18 in September, so they were under the 18 age at 1 July. Previously living at home, and she was not eligible. Does she qualify now?
You need to be eligible at the 1st of July. So if the employee has turned 18 on the 20th of September, I'm assuming that's the 20th of September 2020, he or she won't have been an employee, won't have been 18 at the 1st of July 2020, unless you can show that that person was living independently and not a full-time student prior to turning 18, then you're outside the eligibility. So I don't think she would qualify in that circumstance, but just depends on the actual circumstances. But from what you've described, I don't think she would qualify.
The next question is from Neil. He's just wondering whether the due date for the BAS has changed, whether they need to lodge it before 31 October, or can they lodge it after and just have the figures ready for the Jobkeeper calculation?
Okay, that's a good question. No, the due date hasn't changed, and you don't actually need to lodge your BAS before you do all your calculations or whatever. But clearly, you're going to need to have done your calculations and have the BAS ready to lodge so that you know what your turnover is. But yes, you don't actually have to have lodged it by the 31st of October. there's no, it's just the normal lodgement date as far as actually lodging your activity statement.
I have another question from Nicola. This one's around a staff member receiving Jobkeeper while they're on workers' comp. She has a staff member on workers' comp and they are paying them Jobkeeper as well, and WorkCover topping them up as per WorkCover's advice. Has this changed?
No, it hasn't changed. If you have an employee that's on WorkCover, they're not entitled to receive the Jobkeeper until such time as that WorkCover finishes. So yeah, that is one of the exceptions to the Jobkeeper. You can't be receiving both Jobkeeper and WorkCover.
The next question is another anonymous question. This one's around whether we need to re-register staff members that already received Jobkeeper 1 payments.
You don't actually have to register again. So if you're already in the system and you're already receiving Jobkeeper, you don't need to register again. You just need to go in and advise the tax office what rate the employees will be entitled to from the 28th of September. So no, if you're already registered, you don't need to register again.
The next question is from David. It seems to be aimed towards the increase in turnover alternative test. His business started in September 2018 and they've been growing their business. September 2019 is about the same as September 2020 on our BAS due to downturn. However, the December, March and June quarters were at least double the September figures. Which of the alternative dates should we be using?
Okay, you can choose whether you go back 12 months from September 2020. Sorry, the period prior to that. Or you can go back 12 months from February 2020. So there isn't any other ways or other periods that you can look at. So there is the 3 different thresholds. You can look at the 50% threshold, the 20%, sorry, the 25% threshold, or the 12.5% threshold, and look at 12 months back, 6 months back, 3 months back. So they're the options you have. If your increase in turnover was from September 2018 to September 2019 and hasn't really increased from there, you're probably not going to meet it under that alternative test. But yeah, you probably need to do a bit of work just checking the rules, just to see whether you do meet that test. It can be quite complex, and that's probably something you need to get together with your advisor, just to check whether there is any options for you. But essentially the ones that I brought up in that table, if you don't meet the test using those 2 options basically there are, or the 3 different increases in turnover, if you don't meet those parameters, then you're not going to meet that increase in turnover test, unfortunately.
David Higgs has a similar question around around alternative tests. He had gone on holidays during the September 2019 quarter and had the nil turnover during that quarter. So whenever it's compared against the current quarter gone, it's going to be 100% increase. What options does he have in that scenario?
Yeah, again, it's the same response. You really need to sit down and just look at the turnover for each of those comparative periods and just see what gives you the best answer. It may be that a shorter period might work rather than trying to compare 12 months back. But yeah, that's something you need to sit down with your advisor with and just work through the various tests to see whether you meet that. So again, just go back to that table which I had up, which sets out all of the tests, and see whether one of them fits your circumstances.
We've got another question coming through the chat. This one's from Catherine. She's just saying she's a sole trader, has been receiving Jobkeeper over this period. Do we wait for the lodge? Do we wait to lodge BAS for this year before we report figures for Jobkeeper, or can we just use information from Xero? So I think that question was answered a bit earlier in the first one, and that it's going to be you can use the figures from Xero as long as they're prepared, ready to be lodged into the activity statement, and you need to have that information before the 31st of October.
Yeah, so it's the numbers you're actually going to put in the BAS that are important. You don't actually need to have lodged your BAS. But yeah, there is that requirement. If you have any employees that are eligible that you need to top up, then you need to make sure that happens prior to the 31st of October.
Final question, just around getting a copy of the presentation notes.
Yes, most certainly. We will send those out to everyone that's registered. There will also be, we're also videoing this presentation, so if for some reason you want to watch me again, that video will be available, but more so for people that weren't actually able to log in, I guess. But yes, we will make the presentation notes and the video available for everyone that's registered.
That reaches the end of all the questions. Thank you very much, Randal. I'm sure everyone got a lot out of that presentation. Yeah,
thanks everyone for your attendance. There's a fair bit of work sort of getting your head around how this all works. So yeah, please don't be afraid to contact your advisors at Marsh Tincknell to help you through some of these issues, particularly around the alternative tests. They are quite complex. You need to make sure you get it right. It's all self-assessed, but if you make a mistake and the tax office pick it up through audit, you could potentially have to pay the Jobkeeper payments back, which you don't really want to be doing that. So yeah, so thanks for your attention this morning, and we'll see you again soon. Thank you.